Now, after making the distinction between corporations and partnership organizations like the LLC, we can begin to see how the concept that Professor Sisk is putting together for us can come out to play on an Excel table. Consider the possibility that instead of having employees, you might have 10 service partners. These 10 employees would now become service partners within a limited liability company, and their share percentage within the limited liability company would be tied to the completion of certain services.
Live from Washington, D.C., the American Bar Association, Section of Business Law.
In partnerships, there's a fair amount of flexibility. Corporations, on the other hand, the distributions are generally made on the basis of stock ownership, and there's less flexibility in terms of the economic factors. But for consideration, compensation of service providers. In a pure contract, about all you can do is have a bonus arrangement for each of the partners or each of the parties to the contractual arrangement. But in partnerships and limited liability companies, you can use a profits interest as a way of compensating service providers.
And they would expire, say, quarterly, or they might expire at the end of the year. Nevertheless, the services must be performed in order for the profits to be distributed to the partners. And if we return to our building company example, some of the workers might have a 10% interest, some might have a 17% interest. The percentage can vary according with the business's needs. What are the ramifications of having the employees have a percentage of the profits, such as to federal withholding, FICA, unemployment insurance, workers' compensation, having to deal with the I-9 form, the payroll cost, and other things, such as OSHA? And it's this distinction that Professor Sisk is making. Partners of a partnership are not considered to be employees, and they're not considered to be independent contractors either. After all, the very definition of an independent contractor discludes the possibility of sharing the profits. The major distinction here is whether they're partners or not. And just as an independent contractor is not a partner because he does not share in the profits, the converse can be said to be true. As soon as the independent contractor begins to share in the profits of the business operation, he then becomes a partner rather than an independent contractor. And as well it is with an employee. They don't have a share of the business's profits.
A limited liability company with more than one owner is treated as a partnership for tax purposes.
And it is with that point that we return to. The limited liability company is a type of partnership organization that can be divided into partnership shares. The technique of using a partnership organization and transferring a small percentage of the profits interest has gone relatively unused until this new partnership organization, the limited liability company, which is essentially pushing out just about everything, including S corporations.
Practicing Law Institute is an autonomous, non-profit educational institution. PLI provides continuing legal education for attorneys all over the country.
We have two sessions this morning, very different ones. One's going to be on family-owned businesses, and the other's going to be on international estate and tax planning, both of which probably wouldn't have been on the agenda 5-6 years ago, which I think is one of the most interesting aspects of it. So, I mean, we are finding, and I'm sure we did cover a little bit of family limited partnerships. Today we really want to get in, though under the euphemism of family-owned business, basically the family partnership limited liability companies. A little bit of discussion of S corporations. In fact, so little, I'll just say that there's a bill in Congress to make S corporations more user-friendly, because with the advent of the LLC, then nobody does an S corporation anymore. But man, the problem is I rarely see anybody doing one anymore. Do you?
Conceptually, the concept that we grant partnership profits interest to the partners as a replacement to wages is conceptually valid, but what does the IRS think about this?
Welcome to the Internal Revenue Service Business Tax Line.
Can you tell me, will we have to withhold for the purposes of distributions to the partners?
No, partners are not considered employees. If you receive dividends through a partnership, you should receive a Schedule K-1 indicating the amount of dividends taxable to you.
At the end of the year, each partner's earnings are reported on Form K-1, and it's roughly the equivalent of the W-2 form for employees. But I'm wondering, for purposes of I-9,
No.
is it necessary for us to complete it and submit it?
No. In a sense, they are self-employed. They do not.
Live from Washington, D.C., the American Bar Association, section of business law.
I don't have to make anybody an independent contractor anymore. All I've got to do is give them a profits interest. The profits interest is in my LLC or my limited partnership or my general partnership.
Again, we're going to be examining the federal withholding, FICA, unemployment insurance, and then we're going to add some to it that he did not mention, such as workers' compensation and the I-9 form. A good place to start would be at the IRS's website, which happens to have a frequently asked tax question section on whether or not a partner is considered an employee. Join me at the red arrow again. It's question number 12.1. Are partners considered employees of a partnership, or are they self-employed? Partners are considered to be self-employed, period. If you are a member of a partnership that carries on a trade or business, your distributive share of its income or loss from that trade or business is net earnings from self-employment. Let's stop here for the moment and call the IRS's helpline. Here, right before we call the IRS, let's make sure we know this specialized term. Tax people love specialized terms. We've got to have them. That way we can confuse everybody. So let's bring up 1065accountant.com. Quickly, distributive share means percentage of ownership you have in the partnership, meaning that if you have a 5% ownership in the partnership, your distributive share will be 5% of the partnership's income. And this is what you'll find reported on the Form K-1. Now, let's go back and call the IRS.
Welcome to the Internal Revenue Service Business Tax Line. For questions about employment taxes, including Forms 940, 941, press 2.
Good afternoon. Thank you for holding. My name is Ruth. My ID number is 29.
Hello. I have a question with regards to partnerships. Can you tell me, will we have to withhold for the purposes of distributions to the partners?
No, partners are not considered employees.
Okay.
So the partners must take care of their own federal income tax.
Then we're not going to be withholding for the partners of the partnership.
Mm-mm.
All right. So we'll make distributions to the partners, and then they'll handle their own taxation on their own.
Yep, they are required to handle their own.
We'll K-1 them, as I'm now understanding.
Correct.
We'll K-1 them, and then they'll handle their own taxation.
Correct.
Great. I thank you very much.
You're welcome.
Good morning, too.
Bye-bye.
So there, Professor Sisk is right about the withholding element for federal purposes. Let's bring up to the screen, this is publication 533 from the Internal Revenue Service, the self-employment tax. And at page number 5, it asks the question also, are you self-employed? You are self-employed if any of the following apply to you. And here at the red arrow, you are a member of a partnership that carries on a trade or business. So we're considered to be self-employed if we're a partner in the partnership. Now we might ask, what is the origin of why partners are not considered to be employees? If we pull back to the references section, you'll see that it does give us 3 more references, and we're going to go to one of them here. We're going to go to Revenue Ruling 69-184. Revenue Ruling 69-184 is a response to an inquiry as to whether or not partners were employees and whether they needed to withhold. And the full text is quite short. I'll read it. Bona fide members of a partnership are not employees of a partnership within the meaning of the FICA, the FUTA, and the Collection of Income Tax at Source on Wages Act, withholding. A partner who devotes his time and energies in the business of a partnership is a self-employed individual, rather than an individual who, under the usual common law rules, has the status of an employee. Remuneration received by a partner from the partnership is not, quote, wages with respect to employment, and therefore is not subject to the taxes imposed by FICA and FUTA. Such remuneration also is not subject to federal income tax withholding. Now this really isn't secret information. If you pull up on the web the National Association of the Self-Employed, they'll essentially repeat this in their page on tax talk for self-employment tax for partners, including the exclusion for limited partners. That's right, there's an exclusion from the self-employment tax for limited partners. We're going to get to that in just a few moments. Now right about at this point, I'd like to bring up an article. The article is from Tax Notes Today. It's written by a gentleman by the name of James B. Sowell, Associate Tax Counsel, United States Department of Treasury, and he writes, the thought that a person's status as an employee may cease on becoming a partner may come as a surprise to many. Although commentators and members of the government have increasingly recognized the problems of partner-employee issues in recent years, given that the service has provided no meaningful guidance in this area since 1969, and generally has not pursued this issue on audit. Many advisors and IRS agents alike fail to realize that this issue even exists, which goes a long way to answer the question, why doesn't everybody do it? In the opinion of Mr. Sowell, it's because nobody knows about it. Not advisors, not even IRS agents.